Hello, everybody, and welcome to Confident Compounding with Corey Kramer. Today, I'm going to be taking a look at Celanese Corp, ticker CE. This request came over on Patreon today. They asked me if I could follow up the big decline. I think at one point it was down 20% today in the morning. Looks like it recovered a little bit off that bottom. I went and checked, and I have covered this one before a year or so ago. And I watched some of that video, and it was actually really good. So I'm going to try to make this video a little bit shorter than that one and a little bit more to the point. And then you can look up on my channel if you want to go back and watch that video. It's a pretty long one where I get into all the details and everything that was going through my mind and thinking about at the time. As always, this is just how I analyze stocks, not individual investing advice. So Celanese is specialty chemicals. Whenever I start to analyze a stock, the first thing I look at is how cyclical earnings are. So that's the little green shaded area here under the fast graph. If we go back to the Great Recession, we have just about a 50% decline in earnings. That's the threshold that I actually use to define whether a company is deeply cyclical or not. Now, I had been tracking this one not as a deep cyclical just because earnings recovered so quickly, like within 1 year. And if you look at the bigger picture, during this period, they weren't very cyclical. This little peak here probably had to do with tax cuts. So that wasn't really a market thing. That was just, and then they kind of reverted to, and then this was pandemic. So this was all kind of goofy in here. It wasn't until we get the boom bust of the pandemic that we get into like this super deep cyclicality that we see now. So I hadn't been treating it as a deep cyclical, but one of the reasons people asked me about it back here, it had just fallen, I think it was at $93 a share when I was looking at it. So on a weekly basis that week, it ended at 84, it looks like. But it had fallen like 25% in a day, right about there. And so I made a video about it because I kind of do that when stocks fall a lot. Usually that's when people get interested in whether they should buy them or not. So it kind of plays into my choice there. And I was not a buyer of the stock. They also had announced a 95% dividend cut at that time. And so I was going through and explaining why I wasn't buying the dip and how I avoided experiencing the dip. So if you look at just the basic PE ratio, at some point here, let's say close to when it dove down, it was only like 14. Back here, it was down to 5. But at any time, like the PE was really cheap here. So, and earnings growth looked pretty decent. Let's pull this up 1 year so we're not getting that. So even if we go there, and let's say we go here, we have like 6.5% earnings growth, just point to point over this time. Obviously, there were spikes in between. My earnings growth rate, once I took into account their buybacks and these occasional declines, I would have taken into account this decline. Once I did that, my earnings growth rate was only like 3 or 4%, which is just slightly above the rate of inflation at that period of time. So to me, there just wasn't enough earnings growth to buy that dip at the time. And long-term earnings growth, right? Obviously, when earnings were falling at that particular time, but if they had a better history of long-term earnings growth, I might have been tempted to buy that dip back then. Now, the other reason I didn't buy it was because, one, they had quite a bit of debt, and they still do, which makes a cyclical very dangerous. And so we saw that, it makes a stock whose earnings are falling a lot, particularly more risky. So back during the Great Recession, the stock fell 85% off its highs. And so that tells me what it's capable of doing. Let me check that basic earnings here. Yeah, not too much different. I mean, it's a little bit. So you can see the current complete drop off here matches the drop off. So that's what one of the things the market's probably looking at here. So the problem is when you have a lot of debt that you need to pay back and your earnings fall then the risk rises for everything, basically. And it makes it harder for earnings to eventually recover. So you always want to be careful with that. But we also had very slow earnings growth over this time, even leading up to this time period. And the main reason of owning a stock, basically the quality threshold that I have for owning a stock, is that I want the earnings growth to be faster than inflation long term, including drawdowns. And if it's less than about 5% nowadays, that's just not fast enough to get the benefits of owning a stock, because the risks of owning stocks are high. So you want the reward to be worth it. And that was the explanation that I gave of why I didn't buy it at that particular time. And now we can see that over the past year, it's down another 50%. So people that did buy the stock on that big dip and even post-dividend cut and thought, okay, this is the moment I've been looking for. It pretty much was about as low as it was during the pandemic at that point almost. Now they're down 50% because the problem is when the quality's not there, when the debt's high, the longer it takes the macro environment to turn around, the less likely it is that the company is going to do well, maybe not survive in some cases. And so you kind of have to have those thresholds in mind for yourself. Like, look, what do I want to see in a stock? What's my minimum quality? And I only buy quality stocks that are businesses that can grow earnings faster than inflation over the long term. That's literally how I define it. Now, how you determine whether they can do that is another thing. If it's a company that's been in business a long time, I go look at their history and I say, do they have a history of growing earnings at that rate? If it's a new company, I ask a few things, depending on how expensive it is, how cyclical it might be. I ask myself, how big is their total addressable market? Or is it something I ask myself to think about whether they can keep growing earnings at a good rate or not? Is it a fad? I ask myself most of the time, or is this the type of management that's just trying to cash out to the public? Is a big question I ask myself on businesses that are newer. So it's a different set of questions when you don't have the history to look at, but I lean heavily on, look, what have they actually done? Because a business is kind of like an algorithm in some degree. I realize it's a fast changing world. That's very true. But if you think about it, if you have a product or service, you want to be able to repeating that product and service over and over again is how you create earnings over the long term. And if you can increase the number of people that you're providing those products and services to, you can grow your business. And you the core is you're repeating a thing over and over again, whatever that might be. So it makes sense that if you can repeat something over and over again in the past, you have a reasonably good chance to be able to do it in the future, unless there's something really obvious that, you won't be able to do it. So we get to the next question is, well, is Celanese a buy now that it's down? How far down is it? Let's see if it's at that 85% level yet. 75% roughly. These are weekly numbers. So it's almost where it was in the Great Recession. To me, it's just too risky because of the debt. If they didn't have any debt at all, you can see the total enterprise value is over triple the market cap. So now that doesn't mean if maybe interest rates fall, market turns around, there's world peace, and everything is good, that they couldn't turn around. And if they do, the people that are buying here will make a lot of money, probably. If you bought back in the lows here, roughly, let's say held to 2 years or something like that, we'll call it 2 or 3 years, you're up 400%. So if you get one of these risky ones right, you can get a big reward. But, if you do it 5 times and this is the only one that gets a 400% return, you're not doing as good as it seems if the rest of them fail or just take forever to recover or, things like that. So, and then you have to try to, who knows when the bottom is. I can look back in time and see the bottom was down there, but we don't know, just like we didn't know back here when the stock was 100% higher than it is now, that, that wasn't the bottom, right? So for these are just too hard, too risky, and not enough long-term earnings growth for me to declare it high enough quality stock for me to buy. Now, sometimes I make these videos and the stocks turn around, especially over the short term, and they're like, oh, you missed out on 100% return or something. And that's true. You're going to miss out on the ones that manage to get through whatever problems and turn out okay. But it's really a numbers game. I mean, I want 80% of the stocks, if it's a kind of a deep cyclical like this is behaving, I want 80% of those to make money. They might not fully recover as soon as I want to and things like that all the time, but I only want about 1 in 5 to, I don't want any to lose money, but in terms of like the strategies that I'm using, I'm only really, I don't really want more than 1 in 5 to like lose 80% or 90%. And a lot of times you'll get surprised on ones that aren't as obviously weak as this one is, and they'll be the ones that fall like 80 or 90%. And so if you have one that's pretty obvious, it could fall like that, right? It's not going to take too long from the last video that I made, which was at $93 a share. It might not be too long before from that point in time, this one's down 80%. And it takes a couple winners, big winners, to make up for one big loser like that. So you really want to limit those losses. The first rule is don't lose money, and the second rule is look back at rule number 1. So those are my thoughts on Celanese again after the big drop, and you can look up the other video if I kind of go through. It looked like I was pretty detailed. I kind of skipped through it and I get into all the other stuff. So thanks for watching. If you found this useful, hit the like and subscribe button. Head over to YouTube. I have a free tier over there. Sometimes, or over to YouTube. You're on YouTube. Head over to Patreon. I have a free tier over there. You can ask me questions and message me and things like that. So thanks a lot for the request. I'll see everybody later.